For decades, Americans have been conditioned to think of economic change as a sudden crash, a collapse, a dramatic overnight reset. But real systems, especially monetary systems, don't change that way. They change the way planes land, gradually, deliberately, and with many moving parts working together long before the wheels touch the ground. If you zoom out far enough, it becomes reasonable to ask a serious question. Are we watching the early stages of a managed monetary reset, unfolding slowly, piece by piece, not announced, not declared, but in motion? The concept of structural monetary reform didn't appear online in recent years. It has been debated quietly and seriously since the early 1990s. Harvey F Barnard's work on the National Economic Stabilization and Recovery Act, NESARA, proposed a system built around debt-free money issuance, elimination of compound interest at a systemic level, a restructured tax system, and restoration of monetary sovereignty. Those ideas were circulated among policymakers long before the internet mythologized them. What matters isn't whether the bill passed. What matters is that the diagnosis exists, and once a diagnosis exists, it doesn't disappear. Ideas, especially correct ones, tend to resurface under pressure. One of the strongest confirmations of that diagnosis comes not from activism, but from academia. Global economists have repeatedly warned that bank credit creation drives booms and busts. Productive credit behaves differently than speculative credit, and unchecked credit creation destabilizes economies. These warnings are no longer fringe. They are increasingly reflected in regulatory behavior worldwide. When central banks and regulators quietly acknowledge that credit itself is the danger, you're no longer talking about theory, you're talking about convergence. Look at recent US policy actions not as isolated moves, but as throttle adjustments, efforts to bring manufacturing back on shore, emphasis on higher-paying productive jobs, attempts to rein in credit card interest rates, pressure to reduce consumer price inflation, direct involvement in mortgage markets through Fannie Mae and related tools. None of these dismantle the system, but every one of them reduces reliance on runaway consumer debt. That's not radical reform, that's controlled deceleration. International banking reforms like Basel's Committee on Banking Supervision Framework does not fix the monetary system, but they do something important. They admit fragility, higher capital requirements, tighter liquidity rules, penalties on excessive leverage. These are not solutions, they are acknowledgements. In aviation terms, this is the deployment of the flaps, not stopping the plane, but making it controllable as speed decreases. Alongside regulatory shifts, legislative proposals continue to circulate. Some, like H.R. 25, promise simplification while preserving the underlying debt structure. Others propose moving certain Federal Reserve functions closer to the Treasury. Many of these proposals are flawed, but their existence signals something historically significant. The monetary system itself is no longer treated as untouchable. That alone marks a departure from the consensus of previous decades. What we may be witnessing is not reset, but the approach, a slow alignment of credit restraint, regulatory tightening, productive economic emphasis, quiet hedging, and structural conversation returning to the mainstream. This is not a claim that NESARA has been enacted. It is not a promise of overnight relief. It is not a hidden switch waiting to be flipped. It is the observation that the diagnosis is no longer dismissed and behavior is changing. Resets don't begin with announcements. They begin when the old way becomes impossible to sustain and everyone starts adjusting at once. From a high enough altitude, the pattern becomes visible. Not chaos, not collapse, not fantasy, but a controlled descent. And the most important question may not be when the wheels touch down, but whether we will recognize the landing while it's happening.